Hey everyone, investing in the stock market can be one of the best ways to build wealth over time, but getting started can be intimidating, and it's easy to make costly mistakes if you're not careful. In today's video, I'm going to cover 15 common mistakes that beginners often make when they first start investing in the stock market, and more importantly, how you can avoid them. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. One of the biggest mistakes new investors make is jumping into the stock market without a clear strategy or plan. They hear about a hot stock and start buying without understanding why. Investing without a plan is like sailing without a map. You'll end up lost and confused when things don't go as expected. Having a plan helps you stay focused on your goals and prevents emotional reactions to market movements. Create a clear investment strategy that outlines your goals, risk tolerance, and time horizon. Decide in advance what types of stocks you want to buy, and when to sell. It's tempting to jump on the bandwagon when you see a stock skyrocketing in value, but chasing hot stocks based on hype or news often leads to buying at the peak, only to watch the price crash soon after. By the time most retail investors hear about a hot stock, the big gains have already been made. Buying high and selling low is a surefire way to lose money. Focus on fundamentally strong companies and think long-term. Avoid getting caught up in the excitement and always do your own research before investing. Many beginners make the mistake of putting all their money into a single stock, thinking they've found a sure thing. While it's possible to hit it big, it's more likely you'll face significant losses if that one stock underperforms. Lack of diversification increases your risk. If that single stock performs poorly, your entire portfolio can be wiped out. Diversify your investments across multiple stocks and sectors. A well-balanced portfolio can help you minimize risk and provide more consistent returns. Many new investors overlook the impact of fees and commissions on their returns. Trading frequently or using expensive investment platforms can eat into your profits over time. Even small fees can add up and significantly reduce your overall returns, especially if you're trading frequently. Understanding the cost structure of your brokerage is crucial. Look for low-cost or commission-free trading platforms and limit how often you buy and sell to keep fees to a minimum. Always be mindful of management fees in mutual funds or ETFs as well. Beginners often think they can time the market, buying low and selling high, but even professional investors struggle to predict short-term market movements accurately. Trying to time the market leads to overtrading, missed opportunities, and emotional decision-making. You'll likely end up buying and selling at the wrong times. Focus on long-term investing and dollar-cost averaging, investing a set amount regularly, regardless of market conditions. This strategy smooths out your cost basis over time and reduces the impact of market volatility. Buying stocks based on tips from friends, social media, or news articles without doing your own research is a recipe for disaster. Many beginners invest in companies they know little about. Without understanding a company's fundamentals, like its revenue, profit margins, and industry position, you're just gambling. A single piece of bad news could tank the stock, and you wouldn't see it coming. Always research the company's financials, business model, competitive advantages, and risks before investing. Read the company's quarterly and annual reports and stay informed about its industry. Emotional investing is one of the biggest pitfalls for beginners. Fear and greed can cause you to make rash decisions, like panic selling during a downturn or overbuying during a bull market. Emotions lead to irrational decisions that often result in losses. Selling in a panic during a market drop means you lock in your losses instead of riding out the storm. Create a plan and stick to it no matter what the market is doing. Use stop-loss orders to protect yourself from large drops and remind yourself of your long-term goals when the market gets volatile. Investing without an emergency fund is a risky move. If you need to access cash for unexpected expenses, you might be forced to sell investments at a loss. Having an emergency fund ensures that you're not dipping into your investments when the market is down. This prevents you from having to sell at an inopportune time and keeps your investment plan intact. Build up an emergency fund with 3 to 6 months of living expenses before investing. This cash cushion will give you peace of mind and allow your investments to grow uninterrupted. Many beginners make the mistake of investing money they can't afford to lose. Whether it's borrowing money, using credit, or risking money needed for essentials, this approach can lead to financial disaster. The stock market is inherently risky, and you should only invest money that you won't need in the short term. If you're investing with borrowed money or funds for important expenses, a sudden market downturn can leave you in financial ruin. Only invest money that you're comfortable not touching for at least 5 to 10 years. Make sure your basic financial needs are covered before putting any money into the stock market. 10. Not rebalancing your portfolio. Many beginners set up a diversified portfolio and then, well, forget about it. Over time, the value of different assets in your portfolio can change significantly, causing your investment allocations to become unbalanced. For example, if your stocks outperform your bonds, you might end up with a higher percentage of your portfolio in stocks than you intended. A portfolio that's out of balance exposes you to more risk than you initially planned for. It could also mean missing out on opportunities in other asset classes. Rebalancing helps maintain your desired risk level and keeps your investment strategy aligned with your financial goals. Review your portfolio at least once a year and rebalance it if necessary. Sell some of the assets that have grown beyond your target allocation and buy more of those that are underrepresented to maintain your original asset mix. 11. Ignoring tax implications. Many new investors forget to consider the tax implications of their investments. For instance, selling a stock for a profit triggers capital gains tax, and frequent trading can result in a high tax bill. Taxes can significantly reduce your overall returns if you're not careful. Ignoring taxes can lead to unexpected costs that eat into your profits. Different types of investments are taxed differently, so it's crucial to know what kind of account, like taxable or tax-advantaged, you're investing in and the tax consequences of each trade. Be aware of the tax implications of buying and selling stocks. Consider using tax-advantaged accounts like Roth IRAs or 401(k)s for long-term investments and implement strategies like tax loss harvesting to offset gains. 12. Focusing too much on short-term results. It's common for beginners to get discouraged by short-term losses or to overreact to short-term gains. They might sell too soon or buy more of a stock that's trending up, trying to capitalize on a short-term movement. Focusing on the day-to-day fluctuations of the market can lead to emotional decision-making. Short-term price movements are often driven by noise and don't necessarily reflect a company's true value or long-term prospects. Keep your focus on the long-term performance of your investments. Set specific time horizons for each investment and ignore short-term volatility unless it fundamentally changes your thesis about a stock. 13. Neglecting to set stop-loss orders. Many beginners don't set stop-loss orders to protect their investments. A stop-loss order automatically sells your shares if the stock price falls below a certain level. This can help prevent small losses from turning into big ones. Without a stop-loss order, you're at risk of holding onto a losing investment for too long, hoping it will recover. This can tie up your money in a stock that's not performing and cause you to miss out on other opportunities. Set stop-loss orders for each of your positions based on your risk tolerance. This will allow you to minimize potential losses and keep your overall portfolio healthy. Adjust your stop-loss levels periodically based on changes in the stock's performance. 14. Following the crowd. It's easy to get swept up in the hype when everyone seems to be buying a particular stock. But following the crowd without doing your own research is dangerous. Just because a stock is popular doesn't mean it's a good investment. Following the herd can lead you to buy overhyped stocks at inflated prices or sell out of good investments just because others are panicking. Herd mentality often results in poor timing and subpar investment returns. Always do your own research and make decisions based on your own analysis. Don't be afraid to go against the crowd if your research suggests it's the right move. Invest based on your own strategy and not based on what others are doing. 15. Giving up too early. Many beginners get discouraged when they see their first losses or when their portfolio doesn't perform as expected in the short term. As a result, they might abandon their investment strategy altogether or pull out of the market entirely. Wealth building through the stock market is a long-term game. Short-term losses and volatility are a natural part of investing. Giving up too soon means you miss out on the potential long-term gains that come with sticking to your plan. Understand that setbacks are part of the process and focus on the long-term picture. Stay disciplined, review your strategy, and make adjustments as needed. Remember, the stock market rewards patience and persistence over time. So there you have it, 15 common beginner mistakes in the stock market and how to avoid them. Remember, investing is a journey, and making mistakes is part of the learning process. The key is to learn from these mistakes, refine your strategy, and keep moving forward. If you found this video helpful, make sure to like this video, subscribe to the channel, and share it with someone who's just getting started in the stock market. Thanks for watching, and I'll see you in the next video with more money in your pocket.